An exchange just flipped a switch on silver deliveries, and the ripple is already visible in the price. Fresh data hit. The Shanghai Futures Exchange has announced new rules starting the last day of February. Accounts without approved hedging quotas will receive no delivery allocation on silver contracts. Not reduced, not limited, none. That's an exchange admitting the quiet part out loud, and it changes how you should read everything else happening this week. Before we go deeper, quick safety note. I'm not selling anything. No memberships, no signals, no paid groups, no mentorship. If someone uses my name to pitch you, it's a fraud. Report it. These videos exist to map the battlefield, not to build a funnel. This is education, not personal financial advice. Verify everything yourself. Also, if you've been wondering why Reach has been weird lately, it's covered in the last 2 uploads. And yes, there's a backup channel plan. Details are in those videos. The point is simple. Platforms can turn down distribution overnight, and information should have redundancy. Now, let's anchor to numbers. As I record, Western spot is roughly mid-85s, futures a touch lower, Shanghai spot is higher, Shanghai futures higher still. The important part isn't the exact last digit, it's the gap. The East is paying dollars more per ounce than the West for the same metal. Why would anyone pay a premium if supply were abundant? Here's the part most people aren't connecting. In roughly half a day, silver ripped up again, about 7 to 8%, and that move alone implies hundreds of billions added to the metal S market value. Zoom out 5 days and the rebound from last week's low is around 1/3. That kind of snapback isn't calm price discovery. It's stress showing through the paper. While that surge was happening, SHFE also suspended more account groups for violations, adding to a tally that S unusually high for a single week. You don't need to guess what it means. Their rulebook outlines the authority for those actions. But ask yourself, when do you usually see that level of enforcement clustered inside days? Now shift to the West. COMEX vault reports show metal leaving. One day recently, hundreds of thousands of ounces out. March contracts are being closed and rolled at a faster clip. If that pace continues, March delivery could be covered, but could is doing heavy lifting. Because the pressure point is the relationship between paper promises and registered inventory. Do the math that SC sitting in public reports, open interest in the tens of thousands of contracts represents hundreds of millions of ounces of claims, while registered metal is about 1/3 of that. Roughly 3+ paper ounces promised for every 1 ounce tagged as deliverable. Is that automatically a default? No. But it is a fragility metric, and fragility matters when rules change on the delivery side. Open interest also dipped by a couple thousand contracts, hinting at some short covering. That's not a prophecy, just a clue. And clues are all you get before the headline prints. Mainstream media is starting to leak the story in tiny phrases. Bloomberg ran a segment about gold buying in Hong Kong ahead of the holiday. Small bars, coins, gift demand, the usual seasonal framing. But buried inside was the line that matters. Supply tightness, especially in silver, could threaten how long the momentum lasts. That's not coming from a forum. That's broadcast finance admitting there's a constraint. Bloomberg also published a piece noting that China or S silver squeeze has in T really gone away even when prices pause. Translation, the premium is not a one-day anomaly. And then analysts like David Jensen have been compiling the hard signals: falling Western vault stocks, rising lease rates, and an eastward pull on physical that looks like a pipeline running in one direction. Not just one exchange, multiple. Globally. If you're wondering what higher lease rates imply, think of it as the cost of borrowing the actual metal. When that cost spikes and vault totals shrink, the market is telling you physical availability is tightening. And when availability tightens, volatility usually doesn't get calmer, it gets wilder. Jensen's conclusion is basically, if you think this is choppy now, you may be underestimating what comes next. Paper can multiply, metal cannot. Now add geopolitics, because metals don't trade in a vacuum. China's share of US imports has slid to multi-decade lows. That's not a one-year blip, it's part of a longer decoupling trend. So the old assumption, just tariff them and they fold, looks less connected to reality when supply chains have already rerouted. At the same time, China has leaned into strategic materials, controls on certain exports, stockpiling behavior, and an on-the-ground market where physical commands a sustained premium. That premium is a signal. The physical market is voting against the paper reference price. How long can the two stay married when one partner is refusing delivery? Now, silver versus gold. Economically accessible silver relative to gold is often described as far scarcer than the casual investor assumes. Think ratios that make silver look too important for how little above-ground liquidity exists. And society uses silver in ways it doesn't use gold: solar, EVs, electronics, data centers, communications hardware, medical, defense. That demand doesn't politely wait for mines to catch up. And mines haven't caught up. Years of underinvestment, long lead times, declining ore grades, supply response is slow. So when the monetary demand wave shows up on top of industrial demand, the system becomes sensitive to small shocks. That's why the real price debate matters. Screen price is one thing, delivery price is another. The truth appears when someone insists on metal instead of cash settlement. That brings us back to the SHFE policy shift. Delivery allocation set to 0 for non-qualified participants is not a neutral tweak. It's a gate, and gates get installed when flow becomes a problem. Now, institutions are sending mixed messages, which is exactly what you'd expect in a transition. Bank of America has a bubble risk style indicator that recently flagged a set of assets, including metals, as behaving frothy. They also warn that AI-driven narratives can amplify instability and speculative surges. That's the be careful framing. But in the same week, other big names point the opposite way. You have price targets for gold out in 2026 that are dramatically higher than today, justified by geopolitics, central bank buying, and volatility. And they describe pullbacks as corrections inside a larger move, not the end. So which story is right, bubble or breakout? The answer depends on what you measure against and what time frame you live in. Step back further. The S&P 500 priced in gold has been in a long decline over decades. That's a blunt comparison, but it forces a question. How can the most innovative companies on Earth underperform a metal that just sits there? If that's true, maybe the distortion is in currency and valuation, not in the metal. Also worth noting, the earnings yield on the S&P has hovered near levels historically associated with extreme valuation. There's precedent for what happens when expectations get too stretched. So maybe metals aren't the only thing that can become bubbly. Maybe paper assets have been the bubble for longer than most people want to admit. When trust breaks, price becomes a symptom. Now, I'm going to give you the counterweight because you need it. There are bearish interpretations of recent signals. Silver lease rates have backed off from the most dramatic spikes. That can mean the short-term squeeze pressure eased, at least temporarily. March delivery on COMEX might end up fine if enough contracts roll or close. We've seen scary setups resolve without a visible failure because the system finds ways to reduce delivery demand. Also, Shanghai premiums, while elevated, have been higher in past cycles. Elevated doesn't automatically mean imminent break. And yes, assets that sprint upward can correct hard even if the long-term thesis remains intact. Momentum can reverse and punish late chasers. That's not cynicism, it's market physics. And there is a deeper bearish reality. Paper markets can hold control longer than most people can remain patient. Concentrated shorts, derivatives, regulatory tolerance, policy choices, those tools can persist. The JPM metals case and fines years back demonstrate manipulation is not hypothetical, it's documented. But that history also teaches something uncomfortable. Enforcement doesn't necessarily end the behavior quickly. These structures can limp on for a long time. So if your plan is tomorrow the system collapses and justice happens, that's a fragile plan. The machine can extend time. It can push settlements into cash. It can reshape rules. It can wait out over-leveraged traders. That's why I'm not giving you hype. I'm giving you markers. Because here ES the hinge, all the bearish delay scenarios assume paper continues to define the price. And that's the assumption getting stress tested right now. When physical starts separating, when delivery gets rationed, when premiums persist, when inventory drains, the paper reference becomes less authoritative. You can create endless contracts. You cannot conjure metal bars into existence. Look again at the cluster of signals. SHFE delivery allocation restrictions scheduled for late February. Vault drawdowns and a thin registered cushion versus paper claims. Unusually high enforcement actions on a major exchange in a single week. A persistent east-west premium. Mainstream outlets quietly acknowledging silver tightness. Put together, it's a story about access, not about opinions. Another layer. Macro endgame talk is no longer confined to internet corners. Fund managers have openly argued that the debt trajectory forces a binary path, either default dynamics or monetization dynamics, both of which erode currency credibility. You can debate the exact targets, but the logical structure is hard to dismiss. Rising debt service plus political constraints creates pressure to print. And silver, because it's both industrially essential and historically monetary, becomes a levered expression of that pressure. When gold moves, silver often moves more aggressively in percentage terms. That's not a promise, just a pattern that shows up across cycles. And the recent whipsaw price action is consistent with a market being pulled by multiple hands at once. So what should you watch from here practically? First, confirm the SHFE notice yourself. Don't rely on screenshots. Second, track COMEX registered and eligible categories and watch the direction, not the daily noise. Third, monitor the Shanghai premium day by day. Persistent premiums matter more than one spike. Fourth, keep an eye on lease rates for signs of renewed stress. And fifth, observe the recurring pattern where commodities lift during Asian hours and then get hit during New York Open. If that pattern weakens, it's information. If the physical market keeps paying up while paper tries to lean down, the spread becomes the headline. If delivery restrictions expand, the spread becomes policy. And if enough participants refuse cash settlement, the paper structure loses its anchor. That's the mechanism, not a conspiracy. Mechanics. Here, how's the uncomfortable question? If you were an exchange and you were fully confident about delivery supply, would you ever need to announce no allocation for a large class of participants? Or would you simply let the market function normally? That's why this matters. Not because it guarantees a straight line up, it doesn't, but because it tells you where the stress is in the deliverable layer, and deliverable layers are where confidence lives or dies. I'll close with this. Don't outsource your understanding. Pull primary sources. Read the exchange notice. Look at vault reports. Cross-check mainstream clips for the one sentence that matters. Most people live on headlines. Serious people live on documents. The headline is noise. The inventory report is signal. If you want more breakdowns like this, hit like and subscribe to Vantage Economics. And tell me in the comments which single metric you're watching next: SHFE delivery rules, COMEX registered ounces, lease rates, or the Shanghai premium.